Hello guys, my name is Amber Trades and I'm a forex trader. For those of you that are just seeing my video for the very first time, I'm a forex trader. I trade crypto, stocks, and forex. So what I want to explain to you guys as is something that I've been getting a lot of messages. A lot of my students have been asking me, how can I do my top-down analysis? Because without your top-down analysis, you cannot know where the market is going and where the market is currently reacting from. So if you are seeing this video right now, you are one of the luckiest people. So firstly, if you want to know your top-down analysis, what you do is you go to your daily time frame. You go to your daily time frame. What is daily time frame? That is, daily time frame gives you enough room to see what the market is doing. It gives you enough room to know what the market is currently doing and where the market is currently at. You can understand that. You can see that this market is currently reacting from a demand zone. And this demand zone is a daily demand zone, which I call demand zones. I call them roadblocks. All right. This roadblock is just like you going on a journey. Where you see police and where you see army is not the same thing. When you see army standing on the road, there is a different approach to it than when you see police standing on the road. All right. So now this is a daily roadblock. You cannot compare a daily roadblock with a 4-hour or 1-hour roadblock. So this is a daily roadblock, which you know that the market must respect it. All right? It's likely to respect it. So what you do is that you already determine, okay, the market was on a downtrend, as you can see. This market was on a downtrend all the way here. All right? But getting to this roadblock, what did the market do? It started buying. This is signaling just one thing. It's signaling that the market is now on a bullish trend, not on a bearish trend. So now you have understood that the market is on a bullish trend on a higher time frame. So what you are going to do now is you scale down to your lower time frame. When you scale down to your lower time frame, you are not going to confuse yourself. What you are doing is you are going to look for buys. These are the mistakes some newbies do. When you see the higher time frame structure that is bullish, then you scale down to the lower time frame. Now you are going to see sales. You start looking out for sales, which is wrong. Stick to one direction. Remember, the trend is your friend. Stick to one trend and make sure that you are always on a higher time frame trend. So what you do is you scale down maybe to your 4-hour. When you scale down to your 4-hour, you are going to see that it's going to give you another bigger picture. All right? The bigger picture is going to give you. Now, when you look at this chart, you see that this was where the market was currently reacting from this zone. All right. Now, reacting from this zone, it started buying up. When it started buying up, it just signals one thing to you, that because this market is buying up, what should I do? I need to look for buys. All right. I'm not going to look for sales. I need to look for buys. Now, you cannot enter the market on a 4-hour time frame. You can only enter on a smaller time frame so that your stop loss is going to be small. All right. If you want to enter the market on a higher time frame, your stop loss is going to be very large. So you scale down to your 1 hour. When you scale down to your 1 hour, you are going to see something like this. All right. When you see something like this, you see this was a zone that the market respected. All right. Respected this zone, then pushed up. So this was how I was able to catch this particular buy here. What I did was I simply went down to my entry time frame. Entry time frame is like 15 minutes, 30 minutes. I went down to my 15 minutes time frame. When I went down to my 15-minute time frame, what I was going to look for, I was going to look for a change in momentum. All right, a change in momentum. Now, how do you get a change in momentum? You can see that when this market, it was consolidating for a while, then you had a big momentum up. It came down again and consolidate. Now, at that point that there was a big momentum, a big push up, this is where institutional traders entered the market and pushed this price up. All right? This is where institutional traders entered and pushed the price up. So what are you going to do? You are going to position yourself for the next big move that is coming. Now, which one is the next big move and how can you position yourself? You can simply position yourself by waiting at this particular level. All right? That is where you can position yourself. So this trade was a very sweet trade. After I marked out this zone, that's where the institutional traders entered. What I simply did, I I placed my entry and my stop loss just below the candle, and I was targeting the next high. All right. As you can see, it was a very sweet trade. My stop loss was below because you don't control what is going to happen in the market. The market can decide to come down and then sweep a little of liquidity below this low. But that doesn't happen often. But you just need to be on the safe side. Now, the market came down. It did not sweep liquidity. It just respected that exact zone. Right? Now, this is where some traders used to take advantage of the market. When you see something like this, what you do is you take advantage of this price movement right now, because this price movement is actually clean. When you see this kind of a clean setup, what you do is that you increase your size, you increase your lot size, because you know that your stop loss is going to be small. Your stop loss is no longer going to be at this low, but it's going to be just below this other low. All right, it's going to be just below this other low. So that's when you increase your lot size, because you are going to enter just at this zone. You are going to enter at this first pullback, then you enter again just within here. Then you place your stop loss on this other low. You guys can see how I just did that. Once you place your stop loss at this zone, it has given you leverage to add more positions to increase your lot size so that you can make more money. Now, you wait for your trade. Now, remember, your entry point is also important as your exit point. You cannot be a trader if you don't know where to get out from on the market. All right. You need to understand this market I'm entering, where is going to be my exit point. So your exit point, you are going to notice one thing. All right. Anywhere you see a possible reversal zone, that is your exit point. All right. Depending on your risk capital. For other people, they can decide to take for people like swing traders, they can decide to take this trade up to this particular zone. They can decide to take it up to this particular supply zone, all right, which is giving them very sweet 1:10 risk reward. But things like this doesn't happen often, because these are also roadblocks. These mini roadblocks you are seeing here are also roadblocks where the market can easily retrace from. All right. So that's why you saw my entry was just below this other roadblock, because I don't want to risk up to this point, because I don't know what the market is going to do. All right. So that was how I was able to catch this particular trade. Now, that was on the market opening. I was unable to catch any other trade aside from these other buys that I caught. All right. Apart from these other buys that I caught. So aside from these other buys, how was I able to catch this buy? You can see that the market was reacting from this zone, this particular zone. And as a trader, what you need to look out for is what we call break of structures. All right? Break of structures. Each time the market is breaking highs to the upside, you understand that this market is actually on a bullish trend. For example, there was a break of structure here. And also, there was another break of structure just here. All right. Now, these two break of structures is signaling one thing, that the market is on a bullish momentum. The market is on a bullish trend. Now, it is unwise for you as a trader to start selling when the market is buying. So, when you see this bullish momentum, what do you need to do? You need to wait for the market at that origin of the trade of the trade that caused the break of structure. And where is the origin? The origin of this trade, of this price action, is just here, as you can see. Yeah, yeah, that is the origin. So what you do for you wait for the market to come down to that origin so that you can buy. Now, as you can see, the market came down to this origin. Now, you can see one thing, that I did not just enter immediately, because I did not know, I wasn't sure if the market is going to respect this particular zone. So what I waited for the market to break another high Remember I said anytime you see a break of structure, it's signaling a strong momentum in the market. So I waited for the market to break this high, this particular high that was here this morning, and there was a break of structure. Once you see, well, the maker I saw this break of structure, I knew that okay, this particular origin was the price that caused this break of structure here. So I waited for the market to come down to that same price again. Exactly what I just explained here. I waited for the market to come down to the origin that caused the break of structure. And then that was how I was able to catch this switch buy. All right. And it gave me about 1:4, 1:3 risk reward. So that is basically how you can do your top-down analysis. You start from the top, from the daily time frame to the 4-hour time frame, 1 hour time frame, 30 minutes to your entry time frame. You can decide to enter the market on the 30 minutes or on the 15 minutes, depending on your own strategy. All right. So these are the simple things you need to understand as a trader. Understand your daily time frame structure. What is the market saying on a daily time frame? So if the market is saying buy on a higher time frame, what you do is you go down to a lower time frame just to look for buys. All right. You don't go down to the lower time frame and you get confused and start looking for sales. So you go down to the lower time frame only to look for buys. So that's why you need to be focused on your directional bias of the market, right? So these are just the things you need to do, and this is how top-down analysis works, right? So you need to implement this on your trading, and you are going to see a huge improvement on your trading. So follow me for more. If you have not subscribed to this YouTube channel, subscribe to this channel right now. It does not cost you anything, and I'm going to be dropping educational content like this on this channel. So see you guys on the next one. Peace.